This video's aim is to display how hedge funds have orchestrated the greatest deception the financial world has ever seen. Through the synchronization of various tactics and elements, they have maneuvered their actions and hidden their trail of illegal activities. As such, this has created a sense of uncertainty not only for retail traders, but for other financial institutions. The DTCC is already pushing proposals that would make it impractical for hedge funds to operate under the same model. I will break down everything to the most basic components so that you fully realize the gravity of the situation. It has not been easy to make this, so I ask that you please embark with me for the full length of the video of optimal knowledge and that you drop a like if you found it useful. With no more introductions to be made, we move forward with no further delay. Over the last couple of months, GameStop and AMC stocks have experienced a lot of confusing price action. The rally behind these stocks and constant bullish volume should have them much higher than where the price action has been trading at. Various theories have been risen as to explain this phenomenon. One centers around ETFs, which are funds made up of a whole bunch of securities. Through careful investigation, it was found that ETFs' performance correlated almost identical to that of GameStop. However, that is not the biggest finding. The biggest finding in all of this is the fact that right after GME squeezed, we saw a complete dump in price action for the ETFs. Unprecedented shorting of ETFs occurred through the days when GME was blowing up. We are talking about millions of shares in ETFs being shorted. It is common sense that the only institutions out there who would borrow stocks to short would be hedge funds, which would explain why GameStop quickly dipped right after. This tactic, however, somehow manages to pale in comparison to the one they have increasingly become confident in using. You see, hedge funds found themselves not making that much progress when it came to generating funds and lowering the stock price enough. As such, they decided to instead indulge in the act of eliciting naked shorts. What is naked shorting though? Market makers are allowed to create shares as they see appropriate in order to have liquidity in the market. This is a legal privilege that is bestowed upon them. Naked shorting is when a share that is created that has the effect of increasing the number of shares that are in the marketplace beyond the number issued by the company is considered counterfeit. This is to say, they create so many of them that now there is essentially more shares than what the company ever agreed to sell in the market. Bringing it to the topic of discussion, there were so many naked shares of GME that there is essentially almost an unlimited supply of them. The question has been, how are they introducing all these shares in the scope and magnitude they are doing so without having been caught? There are regulations and security and checks that would typically block this type of manipulation, so why is nothing happening? Well, this is where it gets really interesting. I want you all to sit back and relax because we are going to get into the most complicated part of the video. Feel free to pause and replay back. I'm going to explain it as if you were new to stocks in order to get everyone to understand. This question is the basis of all questions, and we must approach different subjects in order to be able to answer it. First, let's look at short interest. A short interest is essentially the fee you pay the owner of the share when you borrow it to short a stock. As common sense would dictate, if the stock is moving up, people typically don't short it and the short interest would decrease and be low in order to entice more people. If the stock, however, blows up and surges like GME did, the short interest rises dramatically. GME was no exception to this, with a short interest higher than 90 for the most part around December, when it started aggressively moving up. However, the short interest started falling from those highs around the same time GME exploded big time into $500, which is already concerning as it contradicts common performance. I have covered this in my Twitter threads and got a lot of controversial replies on them at times. Many people believe that hedge funds covered, and that is the reason for the drop-off. However, I know there was more to this because if hedge funds had actually covered, the spike would have been in the thousands of dollars, not a mere 500. The short interests wouldn't have dropped the way they did, and more importantly, we wouldn't be seeing action from the DTCC to regulate liquidity issues and other problems so spontaneously out of nowhere. Let's focus on the big question. Are hedge funds still in the deep, or did they cover their position and took losses and are now free from all of this? The media keeps telling me they did, and analysts tell me they did. Am I smarter than them? Absolutely not, but I know some fellow apes that indeed are smarter than all of these clowns, and they have provided extensive proof that indicates that hedge funds are so deep in this that they cannot even cover, because if they did it would cost more than they are actually worth. Let's examine. We covered short interests, now we will talk at length about failure to deliver. Failure to deliver is when one party, in this case the hedge funds, cannot deliver back on what they owe. We know that hedge funds borrowed a ton of shares, and by a ton I believe it to be over 100% of the float, which means more than what was available. This is where the naked shorting part we covered falls into. On April 2, 2021, the most important post came out. A Reddit user that goes by the name of DEJF2 uncovered a huge piece of evidence that suggests that the way hedge funds managed to appear that they returned the borrowed share and covered their positions was through options. Ladies and gentlemen, if I want you to take anything away from this video is this, so please pay attention because the following information about to be given will explain exactly how they manage to not only hide their position to avoid paying up and activating the squeeze, but also manage to secure and confirm that the squeeze will happen. The Reddit user uncovered that on March 31st, there were $52.94 million that were spent on ITM calls, or in the money calls. He goes on to elaborate and disclose that there have been a lot of people taking screenshots and noticing that all the way back to February, hedge funds have been spending millions of dollars on in the money calls. This gives rise to the idea that they are using a two-step process. The first one is through what is called a synthetic long, where a hedge fund is trying to hide the fact that they are net short, which is that they are shorting the stock. They cannot allow themselves to keep showing up they are shorting GME, so they implement a system where they buy at the money calls and then sell them when they reach a certain price. They do this so much to the point where they average a net even position and no longer appear to be shorting the stock. Now, the problem is that on the books it appears they still owe that original amount of shares. These synthetic shorts are only temporary means to appear they aren't shorting, but the books still show that they owe that original amount, so they have to close out on those unless they want to be restricted from being able to keep shorting GME and AMC and every other meme stock. Now, do you remember earlier when we discussed how market makers like Citadel are allowed to create shares, right? This is the part where they come and start making a ton of shares. Then the hedge funds such as Melvin come and buy them right away and right up in the money calls, which are guaranteed to pay. Citadel comes, buys those call options that are in the money from the hedge funds immediately, and exercises, which means that the hedge funds have to return those shares they bought. On the books, it appears that Melvin and other hedge funds bought back shares, essentially cleaning up any debt. The books are unfortunately very easy to manipulate. As such, hedge funds have an easy time delaying permanently through the process I just described in detail the payoff. Now that you more or less understand how they get away with everything, the question is, will they ever cover then? If they can continue doing so, what's it going to take for them to buy back the shares they owe? The problem with using options to hide new shares being created infinitely to keep kicking down the price is that it simply cannot last forever. An entity like a hedge fund consuming more than the world's limited supply of GME based on never-ending borrowing is unsustainable. There is a point where they cannot longer keep paying to delay the process because they don't have enough money. I know it sounds funny to say a hedge fund doesn't have money. They operate in trillions of dollars every year. But the problem with GME and other meme stocks is that the risk exposure they took when shorting is so catastrophically overextended that it's actually greater than the value of their company itself. Like I said, if they were to pay back everything they owed, the amount would be so high they wouldn't have funds to pay it all. They would definitely default on the payment because they simply don't have that kind of cash. They would need a bailout. A question I see being asked a lot is how deep are hedge funds in borrowed shares? How many shares do they need to cover? Remember guys, it's not only meme stocks they shorted. We talked about ETFs and how they are attacking the ones that follow GME and other meme stocks in order to indirectly lower the price further. In fact, hedge funds actually attacked major indexes. They shorted every Russell 2000 security to break GME. You know how they say that a cornered animal is 10 times more aggressive. Hedge funds is the prime example of that. The magnitude of this is beyond the scope of anyone outside of the hedge funds itself. As such, we can only estimate based in the present data that is actually available to us. Keep in mind that the data we are about to talk about only includes a small portion, so the real number is expected to be much higher than what we are about to discuss. Right now, it is impossible to tell the accurate number of shares hedge funds need to return. Posts on subreddits have it over 1000%. However, this estimate is heavily outdated and does not account for ETFs. Also keep in mind that if regulation comes into play and short interests align back to where they should be, they will rise from the single digits where they have been, and go over 2000%. This means that the entire model for shorting is going to break immediately, as that kind of level of short fee is literally impossible to maintain, and a gamma squeezes will take place. People estimate the squeeze to be over $1,000, but that to me with the current addition of shares is nowhere near where the stock will go. Remember, Because of the introduction of naked shorts, it is my strong opinion that retail traders, the people, own over 100% of the stock float. That means that people own more than what GameStop issued in shares because of the endless printing by the market makers. This presents an issue when hedge funds are forced to cover. I strongly believe the price action of GME can move well over $10,000 as a conservative estimate. The amount of people buying more and more every day and not selling while hedge funds need to keep printing in order to maintain a price drop is just so overblown that the result of this bubble will be a vertical climb into the thousands of dollars. Will all this manipulation prevent the squeeze? The answer is an absolute no. If you are a GME or AMC holder, you want to sit down and pay close attention to what I am about to say now. The DTCC has made a series of proposals lately. I believe the reason for some of these changes are because they have realized that the current model of business that hedge funds are operating under is unsustainable, and when the bubble bursts, the hedge funds will default on the payments they owe. As such, the DTCC is setting up amendments to procedures in order to prevent this from happening. I plan on making a whole separate video quickly explaining the rules you need to know. For now, your mission is the following. Hold and buy more if you can. Hedge funds are in a hole that they cannot escape. They are manipulating the price to drop through a variety of tactics in order to try to get people to sell the stock. But the reason that gives me true certainty of success for GME and AMC is not any ruling or technical analysis that displays the right numbers. It's you, the people behind it. When we think about what is happening at a global stake, we realize that the millions of people buying every day with no intent to sell under any circumstances keeps increasing. The ever-growing communities and overall collective mindset of everyone ensures an upward price action movement. The business model in which Wall Street operates is by suppressing prices so drastically that they prevent people from buying, but for the first time, we are seeing the actual opposite effect. The more the price is suppressed, the more people rush in to buy. Like I said, I plan on releasing a video explaining the new DTCC proposals and why they will completely change the game. There is a lot of misinformation being spread around that I intend to correct. We all need to be aware and well informed. I want to thank Broca, DEJF2, the Whack Bateman and every other Redditor posting evidence of this scheme. Their work has helped grow our community and maintain hope and clarity. Let me know in the comments how you feel about it and if you found this video to be helpful and educational. Drop a like and share this video and most importantly subscribe. With that being said, thank you so much if you made it here to the end of the video and I will see you on the next one soon enough.